Hi guys, it's Dr. Ron Miller here with cashbasedphysiotherapy.org, and we're going over a startup series. So let's go over your initial balance sheet and your end of 1 year balance sheet if you use the 101 system, for example. So over here we have our startup balance sheet, and you have to know the difference between assets and liabilities. If you don't understand this, you can go to the money management playlist. I have some videos that go in depth of the difference between assets and liabilities. Or if you haven't read this book yet, Rich Dad Poor Dad, Robert Kiyosaki goes over a great deal what assets are and what liabilities are for your business and for your personal income statements, and kind of just thinking about, but you have to know the difference between an asset and a liability. So here's startup, and this example is going over if I invested $5,000 of my own money. Okay, so if you go back to my previous video about startup capital, I invested $5,000 of my own money. We had all those startup expenses, and we're left with $1,800 as an asset starting out. Okay, we did buy a lot of equipment and furniture, so our fixed assets are property or items that we buy that will help generate revenue and income for the business. Okay, so we spent a couple $1,000s on a lot of that, but we don't get the couple $1,000s as an asset. It depreciates with time, but the value of our fixed assets may be $1,000 right now. We're not looking to make money on this. They're going to depreciate and decrease in value, but we have $1,000 of equipment that we could sell right now. So our total startup assets are $2,800. Okay, as a liability starting out, debt goes here and any kind of expenses you have, but right now we haven't opened, we haven't seen any patients yet, and we haven't taken a student loan out. I mean, not a student loan, a business loan out. You can tell I'm a physiotherapist, $100,000 in student loan debt. As soon as I see debt, I think student loan. But anyway, your business debt, if you use your own money, you're going to be zero here. So your total liability starting out at zero. Now, if you go back to my previous example, if you had a $10,000 business loan, the amount of debt that you still owe would go here, and then you would also have an interest here. But I promote using your own money with this and not really using a bank loan to actually get started. So for this example, we're going to have zero liabilities, which is a good thing, and zero debt. But if you did have a bank loan and you had interest, you would put your amount of the loan and the interest here. Okay, so at the end of year one, okay, in my first year I generated $77,000 of revenue coming in. Okay, and I started out not knowing what the hell that I was doing. So for this example, let's just say you use my system. So let's think that we generate $70,000. Now these are just, I'm keeping it simple here because it took me a while to understand the balance sheet too when I first started. So I'm just keeping things simple. This is a general example. At the end of year one, you have $70,000 in sales. Okay, so we had we're a cash-based clinic, so we're not financing or we're not dealing with reimbursement stuff. So we have straight $70,000 in cash. Okay, now we look at the fixed assets. Okay, so say we added a vehicle to get to and from work. We bought a little more furniture. We reinvested some profits to go back into we reinvested profits to buy some more furniture, sorry. And we looked at, we bought some more equipment. As we generated profit, we started to buy a few more things like an iPad, maybe another chair, maybe some more physiotherapy equipment, okay? So the depreciation of it, it depreciates with time, but just say your vehicle, I just left this blank, because it's up to you to decide on whether you want to put your vehicle underneath your company or keep it personally, and that's something you and your lawyer, you and your CPA have to decide on that. But a lot of times with a business, you can have your vehicle owned by your business and it's protected by the LLC or whatever you do it, and it's not your vehicle, it's the business's vehicle. But it will depreciate with time, but you still have a certain value here that is still considered an asset. Just like our furniture, it's going to depreciate as we use it and gets worn down, but you still have some value there. So say we have $1,000 worth of assets in furniture. We did buy some more equipment, but now maybe we just have $3,000 worth of equipment in the clinic. So we have a total assets of $74,000. Okay. Now, we did have a lot of expenses. We started to pay ourselves a salary after a few months. You can look at some debt, you can look at taxes, rent, etc. So let's go over an example of your liabilities now. So just general expenses to keep the clinic running. I was able to keep my expenses for my first year underneath $2,000 or $1,500. I had super cheap rent, I negotiated the utilities, I negotiated the internet, and everything else. So just say we spend $10,000 in that first year on just general expenses to keep the clinic running. This is just a hypothetical example. Payroll taxes. So after a month or two, I started to pay myself a salary. Part of the salary, okay, so let's look at this. The salary, I paid myself $40,000 in my first year. I'm gonna have to pay payroll taxes on that. So hypothetically, I paid $7,000 in payroll taxes because I paid myself $40,000. Debt, in this example, we did not take a business loan out, so we don't have any debt, so that's a zero for us. The salary I went over, I paid myself $40,000 in the first year. Profit taxes, as you start to generate profit, you may start out every quarter having to pay an income tax on your profit every 3 months. As you start to grow, you have to start to pay that every month. But say we paid $4,000 in taxes off of our profit. Rent was $7,500 for the year, and then our total liabilities was $68,500. If your business in your first year did this and you generated profit, that is a great thing, okay? Most businesses and most companies actually lose money within the first year, okay? So if your balance sheet followed this pattern, if you broke even in the first year, that's a great thing, okay? So the goal is, can you increase this as much as possible, as fast as possible, and then from there, spend wisely, keep your overhead low, and eventually start paying yourself more, and that's going to be your biggest expense throughout your whole company is going to be your salary or your staff salary. That's going to be the biggest expense here. Sorry, but anyway, this is just a general startup balance sheet, end of year one balance sheet, just going through some general numbers so you get an idea of what you're supposed to expect. And again, I have this all outlined in my business pro forma. You'll get all this stuff where the numbers transfer, and you and your CPA can actually go over this stuff. But this is an example of your startup balance sheet, and at the end of year one, if you do it right, you should be able to break even, if not make a little bit of profit. Most businesses are in the red in the first year and lose money, but if you do it right, you can be either break even or make profit. So let me know if you have any questions, concerns. I'm here to help. Don't forget to like the YouTube channel, subscribe to that. Please request to be a part of the 101 forum on the Facebook group, and let me know if you have any questions. Thanks.